Today, the shifting sands of regional migration. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, new data has come from Commonwealth Bank that reveals quarterly migration from capital cities to regional areas over the past 2 years is averaging 15% higher than that compared to the pre-COVID years. The latest Regional Movers Index, that's a partnership between the CBA and the Regional Australia Institute, analyses the quarterly and annual trends in people moving to Australia's regions. A structural break in migration patterns has emerged during the 2 years of the pandemic. Capital city dwellers moving to the regions have generally accounted for a 6.1% share, up from 5.3% pre-pandemic. But meanwhile, the share of regional people making a city move has ebbed and flowed a little more, but has hovered around a 4% share during the pandemic, down from 4.3% pre-pandemic. According to the December quarter index, which is released today, net migration to regional areas has more than double the levels recorded over the 2 years prior to the pandemic. CBA's Executive General Manager for Regional and Agribusiness Banking and RAI Regional Australia Council member Paul Fowler said city-siders have really embraced Australia's regions over the past 2 years. And as we see flexible working arrangements continuing and Australia's domestic and international borders opening up, it's likely we will continue to see this movement as people recognise the benefits of a regional lifestyle. Dr. Kim Horton, the RAI's chief economist and acting CEO, said, with 2 years of the index, we can now clearly see the impact that COVID has had on people seeking a regional lifestyle. It's particularly exciting that many of the smaller regions showing high rates of growth are inland towns. It looks like the pandemic is changing some long-established movement paths, which is a good sign for more balanced population growth across Australia in the future. While net migration to the regions remains strong, the number of people relocating to the regions in the December 21 quarter was down 10% compared to the previous quarter. That was partly due to the high movement already seen in previous quarters, as well as seasonal conditions and accelerated regional housing price growth. Looking at the full year, the Gold Coast remained the most popular destination among metro movers in 2021, welcoming 11% of all people who moved from capital cities. The Sunshine Coast wasn't far behind at 5%, followed by Greater Geelong at 4% and Wollongong at 3%. Australia's two largest capital cities saw the majority of net outflows in 2021, with Sydney and Melbourne representing 53% and 46% of net outflows respectively. And throughout 2021, New South Wales absorbed 50% of the net inflows of people moving to regional Australia, while Queensland and Victoria each picked up 20% and 21% of the inflows respectively. The areas recording the strongest annual growth in migration through 2021 are located in Queensland and South Australia, with South Australia's Port Augusta topping the list at 54% growth, followed by the Queensland local government area of Douglas at 49% and Western Downs at 48%. The Regional Movers Index, which was launched in 2021, tracks movements between Australia's regions and capital cities using CBA's data from relocations among its 10 million customers. And this enables early identification of growth trends and flags places emerging as hotspots, needing fresh thinking on housing and infrastructure. Elsewhere, ANZ has lifted its house price forecast for Brisbane by 5 percentage points to 16%, nearly double the earlier predictions, and they raised Adelaide's growth expectations by nearly fourfold to 11%, amid the stronger than expected market momentum recorded at the start of the year. However, the bank is now expecting larger house price falls across the capitals during 2023 as rising mortgage rates start to bite. Brisbane's house prices are expected to rise by another 6% this year, buoyed by strong interstate migration, according to ANZ. And for this year, ANZ upgraded Sydney's house price growth by 3 percentage points to 9% and Canberra's by 5 percentage points to 9%. And Hobart house prices are now expected to rise 1 percentage point higher to 9%. Perth and Darwin remained unchanged at 3%. Melbourne prices are set to rise by 5%, slightly lower than the 7% the bank forecast in November last year. And nationally, house prices are set to increase by 8%, up from the bank's earlier forecast of 6%. ANZ senior economist Felicity Emmett said the higher house price forecasts were a reflection of stronger than expected market indicators so far this year. We've lifted our forecast for this year to reflect the stronger market momentum coming into 2022, she said. Prices have moved in line with what we expected over the past few months, but some leading indicators have been a bit stronger. We've seen a pickup in housing finance in November and December, and clearance rates have risen to the low 70s from an average of 63% in early December. Sentiment about house prices also lifted, so there does seem to be just a bit more momentum in the housing market than we expected a few months back. Ms Emmett said Brisbane and Adelaide were showing the strongest growth momentum as they continued to benefit from interstate migration driven by affordability and livability. But by 2023, ANZ expects house prices to fall by 6% nationally, larger than the 4% drop expected in November last year. And Sydney's prices are set to drop by 7%, Melbourne by 6%, Brisbane by 3% and Adelaide by 5%. Perth and Hobart are expected to fall by 6% each, and Darwin by 8% and Canberra by 8%. Last November, ANZ expected house prices in Sydney to fall by 4%, Melbourne and Brisbane by 2% each, and Hobart by 5%. The price falls are a little bit larger than we'd previously predicted, and that really reflects the fact that we've brought forward our expectation for cash rate hikes to September this year, Ms Emmett said. We expect the cash rate to reach 2% by the end of 2022, so that will clearly have an impact on the market. But we're not expecting to see prices turn sharply lower because there are lots of other positives for the housing market, like low unemployment and the return of immigration, which all provides support for house prices. National Australia Bank earlier this year predicted house prices would fall by 11% in Sydney and Melbourne by 2023, and AMP Capital has tipped a fall of up to 10% over the same period. Now, elsewhere, national home loan affordability fell dramatically in 2021, with a record calendar year decline of 14.5%, according to non-bank lender Bluestone. Bluestone Home Loans has released its Home Loan Affordability Index for December, revealing the index fell to 93.8 in December 21 quarter, compared to 82.9 in December 2020 quarter. The latest results are also 1.2 points higher than the November quarter figure of 92.6 and above the long-term average of 87, which reflects a high proportion of the average income being required for the average home loan. Indeed, the boom in house prices has significantly increased the average loan size required by buyers as wage growth remains stable, fueling the sharp fall in affordability. The affordability index has now tracked above the long-term average over 7 rolling quarters to December 2021, and although the index eased over October following 6 consecutive rises, this reflected the transient impact of COVID restrictions, they said. While every state saw a calendar year decline in home loan affordability as at December 21, it was New South Wales and Victoria that were the least affordable states. After Victoria fell 18.5% and New South Wales saw a decline of 17.4%. Queensland, which saw record house price growth and migration over the year, also felt the pinch of a fall in affordability of 12%. Slightly behind was Tasmania, that dropped 11%, and the ACT, that dropped 8.2%. Among the other states, South Australia experienced a decline in affordability of 6.7%, while the Northern Territory dropped 7.5%, followed by Western Australia at 2.8%. And commenting on the latest trends, economist for Bluestone Home Loans, Dr. Andrew Wilson, said the strong home price growth over 2021 resulted in buyers borrowing more to keep pace with markets, and with subdued incomes growth and flat interest rates, this resulted in a higher proportion of buyer incomes required for loan repayments. Although home loan activity increased sharply again over December following November's spike in activity, the late year revival reflects a catch-up from the restrictive impacts on housing markets of severe spring coronavirus lockdowns, particularly in Sydney, Melbourne and Canberra, Dr. Wilson said. Last year's runaway increases in prices is already moderating as stricter lending conditions from financial institutions place a ceiling on borrowing capacity. This has the effect of sidelining buyers, resulting in reduced demand and lower prices growth in the year ahead. And when looking at higher-priced housing markets such as Sydney and Melbourne, Dr. Wilson said they continue to record a decline in home price growth levels as a consequence of falling affordability, reducing buyer activity, and satisfaction of pent-up demand. According to CoreLogic's home value data in January, house prices rose in Sydney up 0.6% and Melbourne up 0.2%, and they were marginal compared to the rest of the state, with Brisbane increasing 2.3% and Adelaide up 2.2% in house prices. Dr. Wilson said as Brisbane and Adelaide continue to report strong home buyer activity, this will act to offset overall home lending declines, although national volumes are set to be lower than the record levels of 2021. And looking ahead at owner-occupier and first home buyer loan activity in 2022, he said it will also likely be lower than the record levels reported last year. But we expect investor activity, which remains below the average of its long-term total residential loan market share, to continue to rise, Dr. Wilson said. And while the boom in house prices may dip later this year, he said the outlook for the housing market in 2022 remained positive, supported by recovering local economies, an easing of COVID constraints, as well as the resumption of high levels of migration and continued low interest rates. And elsewhere, maintaining that bullish tone, the HIA said the volume of detached home building and renovations activity has been exceptionally strong for the past 18 months. This was initially driven by home builder and is now being supported by strong employment conditions, low interest rates, and accelerated household formation, said HIA Chief Economist Tim Reardon. This has driven a super cycle of housing activity across Australia that will ensure that the industry continues to operate at capacity throughout 2022. Detached home building activity remains well above historic peaks. The key feature that will mark the turning point in this cycle will be a rise in interest rates, they said. When interest rates inevitably increase, it will reduce households' borrowing powers, and slower house price growth will see banks increasingly reluctant to lend for the construction of new homes and will have a negative effect on consumer confidence. Regardless of the timing of an increase of the official cash rate, effective interest rates have already started to rise and will lead to the same outcomes. Inflationary pressures are very evident in the home building industry, where the cost of land, labour and materials are increasing rapidly. These rising costs have not yet had a significant adverse impact on demand for new homes, as established house price growth has exceeded those cost increases. But as established house price growth slows and access to finance tightens, these rising costs will further impede demand. The adverse impact of slower population growth for 2 years will also emerge as weaker demand for new detached homes from 2023. Despite this slowing in demand for new homes over the coming years, if the national economy remains strong and unemployment low, the bottom of this next cycle will not be sharp, deep or sustained, they said. It is expected that the number of detached homes commencing construction, though, will slow through 2022 and 2023 and reach pre-COVID levels at the end of 2023. In contrast to the detached forecast, multi-unit starts are expected to continue to increase over the next 2 years, but remains below pre-COVID levels of activity. The affordability constraints in detached housing are expected to push some households into townhouses and apartments, and the return of migration will assist in offsetting the impact of a rise in interest rates for multi-unit construction, concluded Mr. Reardon. So if you stand back, you can see some of the cross currents that are currently affecting the market. Migration, particularly into regional areas, is quite strong. The expectation of higher interest rates is coming through strongly as well, as is the concern on housing affordability. Indeed, affordability continues to deteriorate, as shown by our mortgage stress data. More people are in more financial pressure even now before rates rise. Yet, of course, the industry is still propagating the good news, claiming that all is well and more building starts will occur. The point, of course, that they're not touching on, specifically the HIA, is the extended duration of completion of building starts already on hand. According to the data that I've seen, in fact, now you can add an extra 6 to 12 months to expected completion dates for homeland packages, and even more for the high-rise sector. So not only should we be looking at approvals, but we should also be looking at when property is actually available to occupy. Those numbers would give us a very different story, I think. But I want to come back to the housing affordability issue, because that, of course, is where the real question is. Even if house prices ease back a little, with higher interest rates and tighter lending standards, affordability is not going to be easier anytime soon. Until such time as we take a strategic turn with regard to our property market, unfortunately those parameters are locked in stone. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.